Good morning. On September 17th, my mom celebrated her birthday. Happy birthday, Mom. But also, the Federal Reserve cut interest rates a quarter of a point to 4% to 4.25%, essentially choosing to worry less about inflation and more about preventing a recession. Well, this sounds like good news, and markets certainly think that it is in the short term. Let's talk about what this really means for you. Hi, I'm Jim Dunlop, and I'm the managing partner at Advent Partners. Here's the positive. Since that concerning jobs report in August, the S&P 500 has climbed 6%, and small cap stocks have surged 11%. Lower rates make borrowing cheaper, support economic growth, and reduce the immediate risk of recession. Sounds good, right? Bond yields have dropped, mortgage rates are coming down, and suddenly the economy's worst case scenarios look much less likely. But here's the trade-off the Fed is making. Inflation, which has been cooling nicely, but is now ticking back up to 2.9%, partly thanks to tariffs on imported goods. If the economy takes off as investors expect, businesses might find it easier to pass on those higher tariff costs to consumers. And if job growth rebounds strongly, wage pressures could add more fuel to the inflation fire. So while your stock portfolios are likely to benefit from lower rates and reduced recession risk, we might see prices creeping up at the grocery store and the gas pump. And the Fed is essentially saying or betting that they can thread this needle, supporting growth without letting inflation get too far out of hand. For your long-term goals, it's still manageable. We've positioned our portfolios at Advent for exactly this kind of environment. But it's a reminder that in economics, like investing, there's rarely a free lunch. Please stay diversified, stay patient, and reach out to us if you have any questions. Thanks, and have a great day.